Good morning. This is Mayor Valensky with Driving Markets podcast on Sunday, the 24th of July. So let's look at interest rates. Are interest rates going to fall, and what's likely to happen to bond yields going forward? So interest rates, as I've stated over and over again on social media, whether Instagram, TikTok, YouTube, are highly likely to fall. And in fact, September, I would say that 100% likely to fall in September. Then October, highly likely. November, highly likely. December, highly likely. And this is an about turn, an about face with Jerome Powell, head of the Fed. Remember, up until recently, we're talking maybe 2 weeks ago, Jerome Powell, head of the Fed, was stating that they are monitoring the situation, and therefore the markets interpreted that they're not going to reduce interest rates. It was quite hawkish in terms of his approach, and that sent yields higher and markets down. However, the Fed and Jerome Powell and the governors, the presidents of the Fed, are all behind the curve. They've always been behind the curve for the last donkey years. I can't even tell you how many years because it's been so long. They're always behind the curve. What does behind the curve mean? It means that they quite simply are not up to date with what's going on and don't understand what's going on the street. Even though they're great economists and they're great bankers, they're out of touch with reality. So when we're looking at interest rates, we recently on Friday, Jerome Powell said that now market conditions warrant a interest rate cut or warrant a reassessment of interest rate policy. What does that reassessment of interest rate policy mean? Quite simple. It means that they're looking to reduce interest rates. Why are they looking to reduce interest rates, and what's caused Jerome Powell and the Fed to look at reducing interest rates? Quite simply, they see that the employment numbers, in other words, the number of jobs being created, is not as substantial or healthy as was originally thought. And that has caused a problem. What does that mean? The BLS, which is the Bureau of Labor Statistics, has revised down the latest non farm payrolls from jobs created to minus 258,000 jobs over the last two periods, which means there is a net job loss. Now, the BLS, the Bureau of Labor Statistics, also behind the curve, has got a real archaic way of assessing jobs and job creation, and they're even using facsimiles, a fax machine, to get information from the marketplace. That's how far behind they are. So the BLS, the Bureau of Labor Statistics in the US, needs a complete overhaul. So the numbers coming out there, you can't be confident with them, and you're not really sure 100% are they correct or they're not correct. And at the moment, it's proven over the last few years that they are not correct. The analysts are stating one specific number, and the BLS, the Bureau of Labor Statistics, is coming out with another number. And that downward spiral of job creation with rising unemployment has caused an about face of the Fed and Jerome Powell. Remember, he only said 2 weeks ago that there was a robust job market. In other words, his information is void of the truth. His information is actually corrupt in the fact that he's not getting the real live information as regards job creation. And that is what's caused the Fed to panic. And now the fact that the Jerome Powell has stated that rates are going to come down, markets bounced aggressively on Friday, the 22nd of July. The Nasdaq was up, the Dow was up, the S&P was up, gold was up, silver was up. Why? They're expecting cheaper money. However, if you look at bond yields on the 10-year, 20, 30-year bond yields, they did not come down so much. In fact, there is a theory, and I agree with this, that bond yields could actually go up. Why would bond yields go up if interest rates would come down? Because bond yields is what is the reward, the coupon, the payment to investors and traders for holding those bonds, which means that they are going to demand a higher payment because of risk. What is the risk? The risk is quite simple. The risk is that because the US is borrowing more money, and Trump loves borrowing money coming from a property real estate background. Because they're going to be borrowing more money, the Trump administration is going to send the debt sky high, and therefore bond traders are going to demand a higher yield, a higher interest payment, a higher coupon on the bonds that they are being asked to invest in, because they don't trust the US. In other words, they don't trust that the US has the ability to repay the loans. But the US does have the ability in terms of printing money. What will the Treasury do, the Fed? They're quite simple: just print a load of money in order to pay the interest on the bonds. But as that money is printed, it becomes less valuable. And the more less valuable, or the escalation in the devaluation of the dollar, will cause bond traders to demand a higher yield, and that could cause markets to fall. So even though markets have moved up recently, I am expecting a pullback of certain level, significant to major significant, on the basis that interest rates are being cut, because the markets will interpret interest rate cutting as a panic measure by the Fed. In addition to that, they will view the interest rate cuts as a reflection of weakness in the economy. And because there's weakness in the economy, that will push stock markets down short term, near term. So as markets fall, there'll be more and more opportunities to buy the dip. And once buying of the dip takes place and the markets reverse, then we will go on a massive bull market due to liquidity, due to money printing, because the US Treasury will end up printing hundreds of billions of dollars to float back into the economy in order to pay the interest rate payments and reflate the US economy. So you're going to see dollar weakness over the next year, 2 years, 3 years, possibly down by 20, 30%. And you will see stock markets rise to all-time highs on the back of asset price inflation. Asset price inflation will include cryptos will go up, stocks and shares will go up, gold will go up, and silver will go up. Gold and silver will move up significantly due to dollar devaluation and, of course, rising inflation. Remember, inflation is not at 2% or 3%. Real inflation is measured in cost of living. Cost of living is well up between 6 and 12%, or even higher, depending on whether you have children, insurance, travel, and other factors regarding your particular household. The cost of living is the real cost of inflation, or the real measure of inflation, I should say, and that's what's going to be looked at by the consumer. So real wages are going down, cost of living is going up, assets will move up overall, and we will continue this on, obviously, the mentorship group and the Zoom calls that we do. You can join up if you want, and we run a gold group, we run a stocks and shares group, options group, beginners group, and daily trading group. So if you want more information, you can contact me at drivingmarkets.com. As far as this particular podcast is concerned, you can download it on any one of your favorite platforms.